We're going to ask the investor community to prove that they deserve the opportunity to invest in your beautiful business.
That's Pete Worrell, a mergers and acquisitions expert with over 4 decades of experience helping entrepreneurs achieve successful capital gain events by maximizing the enterprise value of their businesses. And he's here today to address one of the biggest challenges that business owners face: how you can maximize the value of your business and secure the best possible exit.
Our philosophy, Justin, is you do not have to be interested in selling your business to want to optimize the enterprise value of the business. All good things come from increased enterprise value.
Pete's approach has helped countless entrepreneurs sell their companies for life-changing wealth. In this episode, he's going to share his unique strategy that flips the script on investors.
What the investor has is a commodity, and we can rent it at the same price from any one of them. It's what the entrepreneur owner manager has that's rare and valuable. We're not trying to sell anything. We're trying to find that investor who's going to most appreciate what this client of ours already has.
2, when to tell your team that you're selling your business.
Oh my goodness, what would the management team think if they thought I was thinking about enterprise value? If you want to have a capital gain someday, why don't you tell your management team that now?
And 3, why potential investors hold all the cards in negotiations and what you can do to level the playing field and get the best possible deal.
Investors are doing transactions like this once a month. So there's this asymmetry of experience. The entrepreneur owner manager is a principal in their own business. They have skin in the game. The investor world, on the other hand, they're not principals in that business. And I'll tell you a little secret. It's not their money. So our role at Bigelow is to level that playing field because, of course, the investors want to pick the pockets of entrepreneurs, and we're here not to let that happen.
What's up, Pete? Welcome to the show.
Hey, Justin. Great to see you. Thank you for having me.
Well, this is fun having you on. We have had a fair number of conversations, in-depth conversations about what it's like and what the process is of selling a business. I think a huge value add that you provide, and just you do a great job of explaining this, is that if someone plans to exit their company and have, if you exit your business, if you sell your company, you're going to have a capital gain. And even if you're just in real estate, you're going to have a capital gain at some point. You can kick the can down the road a little bit with 1031 exchanges and such, but at some point there's going to be a gain. You have, at least half a dozen strategies that, you've kind of walked people through that you think they need to consider prior to this exit. And I'd love to hear about that, prior to the capital gain specifically.
Our philosophy, Justin, is you do not have to be interested in selling your business to want to optimize the enterprise value of the business. Our belief is that, after all, if you want to have a greater success sharing plan with your employees, if you want to put a wing onto the plant, if you want to do whatever, it comes from enterprise value. We would say all good things come from increased enterprise value. So yes, we're very laser focused as outside objective advisors when we talk to owner managers. That's our term for entrepreneurs, entrepreneur owner managers, people who lead and own significant businesses. We ask them, when you're making a decision as a manager, is it positively affecting the enterprise value for you as an owner? And we try to connect those two roles because we find that most of us spend 95% of our time as managers and only 5% of the time thinking as owners. And one of the first things we ask to going to the enterprise value is the strategy of the business so simple that you can say it in one sentence? And to be a little hard on you, I'd say, if not, why not? And actually, is the strategy of the business so simple that your employees can say it in one sentence? Actually, is the strategy of the business so simple that your customers can say it in one sentence? Because if they can, you've eked out a strategy that's so pure, it's going to deliver a name and image of reputation to the firm, which increases the enterprise value drastically. So we really start with strategy, and it's hard because most entrepreneur owner managers are deeply caring about their business, but they're in the combat every day. In combat, you're in tactics, not in strategy. So it takes a little bit of a deep breath, maybe get off site and think about that strategy. And do we have the right one? And what are we going to say no to is part of that strategy also.
Most people that are running a business spend the majority of their time in the business, not on the business. And so there's a degree of coaching that needs to exist to help people get out of the day to day and think about the long term. And you guys do a great job of it. And I know you just had a company here in Austin that you helped have an exit last week, which is tremendous. And I'm sure that some of the strategies you mentioned or that you're going to mention that you probably mentioned to them on here are things you should be considering before your capital gain. So let's get into some of those.
Most entrepreneur owner managers who want to have a capital gain someday are thinking about that issue well in advance. But frequently, regretfully, they don't talk about it with outside advisors well in advance. They're concerned about confidentiality. They're concerned. All of us owner managers are concerned about what do our management team think. Oh my goodness, what would the management team think if they thought I was thinking about enterprise value? Well, as I said to an owner manager yesterday, do you think your management team is pretty smart? Oh, you do. Do you think they know how old you are? Do you think they know what kind of car you drive? Do you think they know where your second home is? Of course, they know all of this. And so actually, one of the things they're speculating amongst themselves is what's going to happen to the business in the long term when this owner decides to go do whatever they're going to do. So actually, our approach to this discussion is very controversial, but we take the approach from based upon experience, which is if you want to have a capital gain someday, why don't you tell your management team that now? What if you said to them, hey, I want to have a capital gain someday, and I need your help. I need your help to optimize enterprise value. And in order to access your brain power and your energy and your help, of course, I'm going to align some economic incentives for you with me. And you can align a simple structure that allows the management team to get a piece of the transaction value that would make sense. And I can show you sometime when we have a paper and pencil why arithmetically, for most owner managers, it makes sense that you will actually earn more if you are able to give away 5 to 10% of the transaction value to your management team. So that's one of the things we ask them to think about very early on is, gee, do you have and I'm not talking about all managers. I'm talking about a handful of senior managers who you can confide in. You could have a non-disclosure agreement with them if you want to. But then when we're all working day to day for the next years in the business, we're working to optimize the business on a day-to-day basis, of course. But in addition, in the back of our management's heads is the knowledge, yeah, but someday the owner's going to want to have a capital gain, and I'm going to have a piece of that too, and I can be helpful to that too. So there's an example where I think that kind of conversation can start years in advance of a transaction.
Well, I love it. And by the way, I think this is an important point just as a standalone, that if you ever want to exit, the time to prep for it is at least 2 years prior, maybe even ideally 3 years prior. And I think most people, they kind of rush into it at the end. They haven't done the prep. Someone offers them, some offer and they like it. They don't necessarily shop it. They don't maximize enterprise value of their company. And they're just happy with the number, not even recognizing maybe what they're leaving on the table if they had done the work or even knew what work to do. And I'd love to hear some of your thoughts on that too.
Well, we live in a world, basically, Justin, where, as you know, our world is awash with capital. Strategic investors are brimming with cash. Private equity investors have all raised 10-year plus funds, FUNDS. Preqin says there's $1 trillion of private equity capital raised as yet uninvested, and that's unleveraged.
Wow.
And so our approach to this discussion is that what the investor has is a commodity, and we can rent it at the same price from any one of them. It's what the entrepreneur owner manager has that's rare and valuable. And so we urge our friends and our clients to think of it that way, to think, actually, we're going to ask the investor community to prove that they deserve the opportunity to invest in your beautiful business. And that's a different approach than almost any other intermediary I can think of, but it's an approach that's designed to get us the best fit investors. And of course, the best fit investors love the company's culture, they love the company's strategy, love the company's management team, and they indicate their love with a higher economic value. So it all comes together.
Well, that's awesome. I love that. And I like flipping the script whenever you can do that, because the reality is the number of reps that these people who are buying companies have gone through is often hundreds, maybe thousands, especially with the legal teams involved. with the brokers involved. And so I think it's so important that you have someone representing you that knows this process, but can also position you in the right light and can create an even more competitive process, but bringing in all the different potential suitors and acquirers that fall in different industries, right? It's not always just private equity. I mean, a strategic buyer could make more sense in some instances. And you
Sure.
guys kind of lay that out.
Sure. Family offices can be an investor or an acquirer. Also, in the US and North America, there are less than 4,000 publicly owned businesses. There are 6 million private businesses. So let me say that again. There's 4,000 public entities. There's 6 million private entities. Almost everyone who listens to this podcast's information about the M&A market comes from what is in the public market. Whether they read the Austin paper, the New York Times, the Wall Street Journal, whatever they read. Why is that? Because that's the data that's disclosed. And yet that's a tiny little market that has literally nothing to do with the private transaction market. In the private transaction market, as you just pointed out, the great nuance, most entrepreneurs go into the market once in their lives for sure the most significant financial transaction of their life and the legacy enhancing transaction for their business. Whereas, as you pointed out, investors are doing transactions like this once a month. So there's this asymmetry of experience, meaning the investors have way more. There's an asymmetry of information, meaning I've seen frequently investors come to first meetings with entrepreneurs with a draft of a market study that they've already commissioned. And there's a principal agency difference. And what I mean by that is the entrepreneur, owner, manager is a principal in their own business. They have skin in the game. And because that's the case in positive psychology, we would say they have cognitive biases that are affecting them. If they know about them, it's good. But either whether they know about them or don't know about it, it's affecting them. The investor world, on the other hand, first of all, they have asymmetry of information, they have asymmetry of experience, and they don't have any cognitive biases about the entrepreneur's business because they're not principals in that business. And I'll tell you a little secret. It's not their money. So they feel completely differently than those of us who are business owners do. So our role at Bigelow is to level that playing field because, of course, the investors want to pick the pockets of entrepreneurs, and we're here not to let that happen. What our clients have built over periods of years and decades is so valuable, it's hard to be duplicated if it can be at all. We want to make sure that they get a fair shake in these kinds of transactions.
Yeah, that's brilliantly said. You had mentioned a great strategy to employ with the employee pool, right? For some equity ownership for executives, key people, key personnel. Yes. What are some other strategies that people can think about in the event that they ever want to have an exit? And for a lot of people, I think it's important to realize that right now, you may not feel like you want to exit, but you might have a life event, you might have kids, another kid, complication, parents, health, like all these things that come up that in a moment's notice, everything changes. And so anyone who thinks that they just want to run their business in perpetuity, I think it's a very small percentage of people that actually end up doing that. So I think it's good to be thinking through, well, if I do sell, what should I be prepared for? So I'd love to learn more of your capital gains strategy early.
So first, let me say that, as we know, summer comes to an end. Seinfeld stops its episodes. The Beatles break up, and we're all terminal. So you can decide not to sell your business. It's America. You can decide whatever you want. But you are going to be terminal, and you can be carried out there feet first if that's what you desire. Most of our clients feel like, wait a minute, I don't want to do that because I want to exert some responsibility about who is going to be the next owner of this business. Entrepreneurs have this fight between our head and our heart. Our head says, we know we should move on. And by the way, our professional decline does not start at the end of our career. Our professional decline starts at the peak of our career. So we all want to move on in some way, or we ought to think about doing that. In our heads, it's coming at us every day. In our hearts, we think, yeah, but no one's going to love this business the way I do. No one appreciates the customers and the employees the way I do. And so we have this war going on between our head and our heart. And our clients and our friends sort that out. Sometimes it takes them a period of time frequently a period of years to get through what in positive psychology we call ambivalence, that feeling of I want it, but I don't want it. I want it, but I don't want it. And one of the things we do during this time is to prepare. So another piece of preparation would be, do we have the right outside advisors to be able to help us? What I mean by that is we probably all have Joe or Josephine, who's been our trustee lawyer and done all of our real estate leases. And if we're going to do a $100 million transaction, I would like to work with an M&A attorney that does a $100 million transaction once a month. So we may need some temporary help. So a legal special M&A counsel. We are going to want to talk to our trust and estate counsel, because if we think there's going to be a capital gain in our future, meaning 12 to 60 months, and our trust and estate attorney knew that, an example might be they might want to move some ownership out of our estate to be able to make sure that the capital gain comes into another interest, whether it's our children or grandchildren, philanthropic, whatever. So there's fundamental things we can do to leading up to a transaction, which is better. And a tool that we've been employing a lot recently is, as you probably know, in due diligence today, every private equity firm will commission a third-party market study in due diligence. I'm talking about a quick and dirty market study, 2 to 3 weeks long, from firms like Bain, McKinsey, Parthenon, IGS, Stacks. I'm sure I'm missing some, who they are completely focused on doing this kind of work for private equity firms. 15 years ago, we decided, wait, if they're going to do a market study in our clients' firms in due diligence, why don't we commission a market study 3 years in advance, so that we just have a client, for example, right now who's in the oil burner business, where they make burners for power burners and makeup air. These are all intellectual property protected. It's a beautiful business. But when you ask the owners, what's the size of the addressable market for the power burner business in North America? They couldn't tell you from a coffee cup. Well, what if we went and commissioned a third-party market study and we realized here are the 8 market segments. We only have a right to win in 5. So let's stop going after those 3 other market segments. Let's put our eggs in these 5 market segments. And wow, what a wonderful thing that is leading up to a capital gain transaction. And it isn't bad either to have that third-party market study by an identified firm who's known to the investor community, because the investor community will then use that study in their work. So I think as we get through that war between the head and the heart, and look, some entrepreneurs walk in the door and they know they want to go to market. The vast majority, however, take some time to work through that. We can do these things, which are great preparation and add significantly to the enterprise value of the business.
I love it. Well, and the whole, this whole idea of we're going to make decisions that add to the enterprise value is so powerful, because I think a lot of the time people are making decisions too short term, or they're making decisions on, hey, I just want to grow. I just want to scale. And, I think there's some interesting things that we could walk through there. But in fact, this might be a real good time to talk about it. So when companies are focused on growth and on scale, and we saw in the last decade a real unhealthy pursuit of this, even in the face of profit, like let's actually throw profit out the door because we care so much about revenue growth. I would be interested to know, and I know you have tons of studies on this, but the impact of EBITDA margin as compared to total annual revenue.
So in our world, sometimes growth is substituted as if it's the same thing as success. And, we definitely do not believe that. And I think you've just come through a period of time, particularly with early stage businesses, where the game was to do a startup to get a valuation as quick as you could, to operate, to try to get growth, and profit be damned. And if you need more capital, you just keep getting it at higher and higher valuations because you have a bunch of sucker investors who are going to do that for you. I feel that thankfully that chapter has come to a complete end, and that is not going to be able to work for a while. We are very patient for growth. We are impatient for break-even cash flow in early stage situations. And in more mature situations, we look and we ask, How profitable is your profit? And by that, what we're talking about is whether we're talking about pre-tax income, EBITDA, so whatever number that you want to focus on, that's the bottom line, it's fine. And we would ask, what is the percentage of that EBITDA margin to your total revenue? Do I care nominally about profit? No, I do not. I use profit as a proxy that tells me if you have a 5% EBITDA margin, wow, you're working really hard to make very little cash flow, and you must be in a business where the customer does not appreciate your product very much, or it's able to be substituted very easily. On the other hand, if you make a 25% EBITDA margin, your customers are telling you, we love the product or service that you're giving us because they're allowing you to make that big margin. Those are our clients. And those are the businesses that have the most value because investors are really smart. And so they know what I'm saying is that those high profit margins are indicative of something. So we just had a discussion the other day with a couple of experienced entrepreneurs, and their business is heading quickly towards 200 million in revenue. And they were talking about revenue, and they were talking about their sales team was compensated on revenue, and their operations team was compensated on revenue. And finally, I raised my hand and I said, "What are you guys talking about? What's the pre-tax earnings on that 200 million?" And they said, "Well, our goal is 10%, but we'd be happy with 5." And I said, "Well, first of all, I don't like that language that you'd be happy with 5, but do you understand that 5% of 200 million, which is 10 million, gives you a valuation, but 10% on 100 million is a much, much more valuable business." And these entrepreneurs looked at me like with cross eyes, like, "What are you talking about? We've never heard that before." I said, I'm talking about in a capital gain situation now, $100 million business making 10% is far more valuable than a $200 million business making 5%, even though both of them have $10 million of EBITDA. And it's obvious why, right? The market's telling you something. And so we try to have entrepreneur owner managers be focused on the right numbers. And the right numbers have to do with, you may have to sacrifice some quick scale in order to optimize the pre-tax. And the reason we think that's so important is because if you optimize the pre-tax and get those margins high enough, you'll have plenty of cash flow for growth. And if you don't, you won't. And I just had a discussion with someone who's a world saver, and they're in a business which is a very laudable business in the substance recovery rehab business, which is a business we understand quite well. And they were arguing that they only want to have a 2% profit because they want to make sure they're helping the people. And my point to them was, if you have a 2% margin, you're actually endangering your mission. You're actually going to go out of business and you won't be able to serve these clients that you say that you care so much about. You need a 10% margin in order to be sustainable. And so we'd like to get that message across to entrepreneurs who may be listening to this, is that I'm not talking about price gouging. I'm not talking about anything untoward. As I told you, I don't care about profit in and of itself. But to have a business which has a culture of having a great, healthy profit margin is really a great thing.
Yeah, I love hearing you say that, because this fundamentally has been the way I've looked at businesses. And for the last decade, I just was scratching my head, just not understanding how this could be reality, that it's grow revenue at all costs, even if it puts the business in jeopardy. It made no sense to me. So I like that we're kind of coming back to reality here. And at some point in time, history does repeat itself, and we'll probably get back into a season of that, but it probably is going to be a long ways off.
Hope so.
A lot of great lessons have been learned. A lot of companies crashed and burned. A lot of down rounds have happened. A lot more are going to happen. I mean, it has created some true carnage and chaos in the markets. But something else that I think is important to discuss is all the language and the acronyms and how intimidating it is when you don't live in the investor world, you live in the founder world, but everyone's valuing your business based on multiples and based on acronyms and based on different, I would call them different equations for profit that have several different names. So I would love to hear your thoughts on that, and maybe what an entrepreneur can do to be in a better place come exit time.
So that's a great question. It's a challenging question. Most entrepreneur owner managers know that. First of all, most entrepreneur owner managers who are successful are absolutely experts in their business. So if they're making these kind of paper coffee cups, I bet you they know more about paper coffee cups than anyone in the world. They don't typically know a coffee cup from EBITDA margin, however, because they haven't been involved with that kind of thing. And I find that today that with the proliferation of peer-to-peer CEO groups, there's a rapid adoption of slang language, which at least in our industry, I feel like has not helped our owner managers a lot. Example, EBITDA multiple. So wherever you go, you hear in the golf club, the workout club, the yacht club, wherever you hang out, people talking about EBITDA multiples. Did you hear she got a 10 times EBITDA multiple for her business? Did you hear that he got a 4 times multiple? Oh, that poor guy, she got 10. No, no. I mean, this has not done our world any good. Let's talk about valuation for a second. What's the single largest driver of valuation? It is, what is your go forward plan? Let's not forget that when we sell our business for $100 million, that's our exit, but that is the investor's entrance. So they're really not very interested in what you did last year, 2 years, 5 years ago, as much as they are what you'll do next year, 2 years from now, 5 years from now. So actually, EBITDA multiple, which is often quoted about, is it a 6 times multiple? Is it 8 times multiple? Just forget that. That is an output, not an input. Let me just illustrate it quickly. If you and I were going to go buy the most simple 4-unit apartment building, what would we look at to drive our knowledge of value? Well, we'd look at the rents. And we'd look at the rents going forward, wouldn't we? We wouldn't look at the rents going back. The only reason we'd look at the rents going back is to do a validation check on do the rents going forward make any sense. And let's say we have a plan that says the rents are going to go up by 5% per year. And you and I, Justin, might say, yeah, but we got to add up all those rents for the next 5 years. We're going to discount it back to today using time as a discount and also using risk as a discount, execution risk. And then you might persuade me, hey, Pete, that apartment building needs a new roof. We got to take that out, and the needs to be the pavement needs to be restriped. We'll take that out. We're going to get a value. In business, we call that value enterprise value. If you take that enterprise value of that 4-unit apartment building and you divide it by last year's rent, you'll get a multiple. That's the EBITDA multiple. That's an output, not an input. So where we began to talk about EBITDA multiples as slang for history, looking at outputs, like that was an 8 times multiple, that was a 6 times multiple, it was never intended that it be the device that you use to drive the value of your business. The value of the business is driven by the go forward plan. That's another reason why we believe it's so important to bring your management team into the conversation early, because actually what I've found over the last 40 years, managers, non-owner managers, frequently have a point of view about the 3 to 5 year plan. And some of them may feel that they actually were being held back by the owner who became a little risk averse as they got more and more successful. And so sometimes when you let a management team imagine, what if you had a new investor? And what if the new investor had a really big checkbook? What are the things that we could do then? Then you'll really open up the door to have a healthy discussion about the 3 to 5 year plan, which is the thing that drives value.
Well, and this makes tons of sense because you also hear often about these outlier multiples, and you're like, how on earth did they get such a high multiple in an industry that is atypical for, that's double or, triple what someone would get. And that is totally based on the output of, compelling vision of the future and what this business can do, and people being willing to overpay because they know what they can get. They know that they're at least going to get, in most instances, private equity wants at least a 10x multiple, from their entrance, and hopefully more than that. But I think when you paint that compelling vision of the future and what the company could be, what it looks like, what it's positioned to do, all the market share that you haven't grabbed in these different areas that's primed to grab through these market studies, that's where you can get these real outliers of multiples that don't make sense.
Yes, I'm agreeing with you. I'm nodding my head, agreeing with you. The other place you get it is that, management teams are really smart, and they look around and they see what their competitors are doing. And sometimes what management teams, I'm speaking of non-owner management teams sometimes could feel like, hey, let me at it. Just let me at that capital. We need a $25 million distribution facility on the West Coast. We really ought to have a distributor in Germany. And sometimes owner managers who have achieved a level of success on that life arc that they're on, early on when they were down at the bottom left, they were willing to take those kinds of risks. And today, if someone comes along like me, who's a wise guy and says, I think the business might be worth 75 million, that owner managers sometimes can just tap the brake because they might feel like, if it's worth 75 million, that's really scary because I got it from 0 to 75. I could easily take it back to 0. So I got to be really careful to do that. And so frequently those management teams have been a little bit slowed down by the owners.
Yeah, I can see that. And I also think when you engage the right people, you engage Bigelow, you find all the potential acquirers in every vertical, every niche. And a lot of the strategics will buy not based on what it produces, but what it will produce for their portfolio. And in many instances, these companies buy other companies, and the company that is being acquired doesn't even have to make money, though it might, because they make money just by implementing, that offering or that value add into their company, into their, what they offer their customers, into, another strategic play that impacts maybe ancillary companies as well. So it's fascinating to see where the value can be derived from as you kind of promote and market the company you're looking to sell the right way and to the right
Yes.
people.
Yeah. And so what we're always doing, Justin, is we're always seeking the best fit investor. We explain to our clients, we'd like them to banish the words selling the company from their vocabulary, that we're not selling the company, we're acquiring a new investor. And we go after it, we go at it just like that, very proactively going after the investors who would really most appreciate this business. And as you pointed out correctly, many times those investors are in adjacencies or in places that you wouldn't have thought of. This is why, there's another piece of controversy for you, sorry. This is why we believe that vertical industry specialization is an excellent strategy for the M&A firm, but for the client, not at all. Because for an M&A firm or for any other advisor, it's easy to take your most junior people. And if I'm going to have them be specialists in the aerospace industry, it doesn't take a newly minted MBA very long to figure out who all the players are in the aerospace industry. We know all the investors. We go after them over and over, and they pay average multiples, and we know what those average multiples are. So if you have a below average business, if you want to get an average multiple, go to an industry specialist because they specialize in getting those industry averages. We, on the other hand, want to go into every industry with a beginner's mind. And we go into it asking, so what is the positioning of this business that makes it so special? And who is the investor somewhere in the world that's going to most appreciate that? So we're not trying to sell anything. We're trying to find that investor who's going to most appreciate what this client of ours already has. We had a woman say to me just recently, Pete, I noticed on our investor work, and you may know we don't write a prospectus, a book, a SIM. We haven't for 15 years. We use a different technology. But this woman said, in the slide, very second slide you're using with investors, talking about my culture. And I said, yeah. And she said, you're kind of scaring me because I feel like I have a scary culture. I'm way out there with my culture, and I'm not sure the investors are going to like it. And I said to her, Lisa, if they don't love it, we don't want them as an investor. You spent 40 years building this beautiful culture, and it's part of what differentiates the business. We want to find investors who say, we love that. And of course, we did find that.
That's
investor.
great. That's so smart. I know we're coming to the end of our time, but I have to ask you, I've got a bunch of friends that get offers all the time to, buy their business. They have, PE firms, they have banks, they have brokers, just people constantly reaching out. What do you think about taking those meetings? Does it make sense? Should people lose, you can make the argument you might lose focus if you're taking these calls, but on the other hand, it's kind of nice to know what the value of your company is and how much people like it. Curious your thoughts.
So the way that we get to know fair market value for anything is by creating a little market. And I can show you someday some data, which will show you that when you take a company and it's approached by one investor and they get an offer, compared to when we create a little market for the same company and then we get offers, the dramatic difference, frequently more than 100% difference. Having said that, you're right. The best businesses today get approached daily or weekly. Sometimes they get approached by private equity investors who are legitimately looking at their industry and have done some homework. Sometimes they get approached by a business broker who actually is fishing for listings and doesn't represent anyone. But if you can sort out who's who, and if you have a legitimate overture by a potential investor, we take the controversial approach of saying, actually, we think if you're interested, you can take that meeting or that call, provided you understand this is 100% for you. And you can make it really clear to the people on the other side. I'm going to take a call or a meeting with you because I want to learn. I want to learn about, why are you interested in my industry? Why are you interested in my company? Tell me about the other industry investments that you've made. Tell me about what's happened to the other management teams in the companies that you've made those investments in. What happened when the going got tough? How did you behave? How did those managements behave? And when the investor says to you, yeah, Justin, that's great. Just send me 3 years of audited financials and I will send you an NDA. You say, no, thank you. I'm not going to send you 3 years of my financials because that's what the company used to be. I want my company to be valued on what it's going to become. And I'm not going to sign an NDA because I'm not going to talk about anything that's confidential about my company. This is all going to be you talking to me about your strategy. So if we have entrepreneur owner managers who can handle that, that's complicated, but if they can handle it, I think it's wonderful when they get a meeting or two with investors because they find out what other smart people think about their industry and about their company, and they always learn a lot.
And I love it, though, because you're flipping the script again, because it is standard that you would sign an NDA. And I love that you're giving pushback and saying, no, actually, we're not going to do that. So that's brilliant. And no, we're not going to send you the financials that you've requested. I absolutely love that. Pete, this has been so much fun. You have so much knowledge. And I know you have a book that I think would be great for people to know because it's all about enterprise value. So number one, where can people learn more about you? And number two, where can people find your book?
So our website is bigelowllc.com, and it is filled with immediately useful information for entrepreneurs. We freely share all of our intellectual property to business owners, even to our competitors. We put out a lot of IP and we want to freely share it because we're trying to help entrepreneurs. Our book is called Enterprise Value. It's published by McGraw-Hill. It's available on all the bookstores. It's also available on audible.com, read by me. If there's a business owner listening to this, Justin, I would make you an offer of a gift, which is we would be happy to, for people who are friends of yours or listen to your podcast, the Lifestyle Investor Podcast, to overnight them a copy of Enterprise Value of no charge, just as a gift from us and from you, so that they could read about the questions that other entrepreneurs had as they were thinking about having a capital gain someday. And the book is filled with the stories, all true, probably will make you laugh a little bit.
I love it. That's so awesome. Well, thank you so much for your time. I love ending every episode with a question to our audience. So to those of you tuning in, watching, listening, my question to you is this: what is one step you can take today to move towards financial freedom and move towards living a life that you truly desire, that's on your terms? So not a life by default, but a life by design. I know there's tons of nuggets from Pete. Pick one and move forward. Thanks so much, and we'll catch you next week.
Love it, Justin. Thank you.
If you do want to learn about exit planning from someone else with a proven track record, check out my video with Nick Bradley. Nick has completed over 100 transactions, 26 exits, and has created $5 billion in value for private equity firms. In our interview, he reveals exactly how PE firms operate and the sneaky strategies they use during acquisitions to get the absolute best deal. By learning their tactics, you can better position your company and set yourself up for a much bigger exit.